Good morning, everyone. We're going to give it a minute or so. We see a bunch of people hopping on, and then I'll do an introduction. Most of the people are getting on. All right. Well, I think there's going to be some more people joining, but first, Josh and I would like to welcome you this morning to our tax webinar with Derek Smith. We're super excited to have everyone here. We're hoping to provide a lot of really good information to you today. We do these monthly webinars to provide information to clients about relevant financial topics to help make sure that they continue to be financially successful. Sometimes we partner with other professionals to do this that have some expertise that's beyond our expertise. And in this case, I think taxes is a really big issue, especially with the change of administration. A lot of people have questions and are wondering, well, what's going to happen to me tax-wise now and even in the future? And of course, some of that speculation, but we brought Derek here today to talk a little bit about what we expect in the future and how to maximize those tax changes. So it's going to be a really good topic. Derek's going to be with us for about the next hour. He has information he's going to be presenting, but also you'll have opportunities to ask any specific questions that you might have. It's going to be super casual and conversational. So we're happy to have you here. So thanks for joining us. A little bit about Derek. Derek Smith is a shareholder at Markovitz and Dugan and Associates, which is a full-service CPA firm here in Pittsburgh. They have about, I think, 40 associates, and they work with individuals and business owners on various areas of tax planning. I'm sure he can tell you a little bit more about that. He's very knowledgeable in most areas of planning, and I anticipate he'll be able to answer any questions you have very easily. So Derek, welcome, and thank you for doing this with us today. How long have we known each other now?
Oh, it's been a long time. It's longer than I want to admit, probably, Melissa.
I know. I think when we first met, it was probably like 10 plus years ago.
Yeah.
You had your office in Squirrel Hill, and my office was still up in the North Hills. So
yeah, I honestly think we met at New Dumpling House and had lunch at New Dumpling House. I think it was Andrea Marquis who introduced us, if I remember.
Oh my gosh, that's who it was. You're right. So, well, thanks for doing this today. I mean, we're really excited to have you.
Well, Josh, Melissa, thanks for having me so much. It's a great opportunity. We are in December now. For those of us who are big believers in planning and making sure our clients do as much as they can before the end of the year in regards to their taxes, this is sort of our time of the year. Tax planning season is the time of the year that we love. Once you get to do a tax return, all the decisions have really been made. There's some small decisions we make here and there, but the tax planning during December when we're planning is when we can change things to better, change things to make differences in regards to taxes, make legitimate possibilities and differences for someone. So we love this time of year. I'll probably do somewhere between 75 and 100 tax plans between now and the end of the year. And it's just a time in which we can really make that change. A lot of firms don't do this. It is definitely the difference between the firms that know what they're doing, the firms that are not. It's amazing how many new clients I walk into our office and I say, so what planning did you do last year? And they look at me and they go, planning? There's a possibility of planning? We just do our tax return. And it's such a missed opportunity to do so much more.
Yeah.
Well, I think we both.
Go ahead, I'm sorry.
I said at the end of the day, what we don't want to hear from a client is that, they didn't know they had this opportunity to do this, or they didn't have the ability to do this, or they could have done something different if we got to that point. So we never want to have to say that to a client at the end of the day.
Yeah. Well, we feel the same way here. I mean, obviously, from our standpoint, what we do from an investment standpoint, most of that stuff has to be done before the end of the year. And a lot of clients don't realize that. They start calling us from January to April, but there's really not as much we can do. I mean, there's some tools on our tool belt, but that's also why, we want to bring this information to everybody now, is we want to be proactive, not reactive.
Right, and we work very closely with you guys, with your clients, other financial advisors, attorneys, bankers, when we're doing these tax plans to try and make sure we have the right information or to make great possible choices. This year where there's not an RMD available, you have to take an RMD. A lot of clients are like, well, I just don't want to take it. And, we are looking at those clients and saying, this is a great planning opportunity. Instead of having to take $100,000, maybe we take 50, keeps you in the 10 or 12% tax bracket, keeps your Social Security less taxable, but we basically get to take that money in a very low income tax rather than taking it at a much higher income tax later. So, even the obvious choice of there's no RMD, we shouldn't do nothing. The answer to that may be no, there might be a better choice to be made. So, and we work closely with you guys as the financial advisors to kind of decide where they're going to be, what they have, what their options and opportunities are, whether that maybe even just if they don't want to take the money into their after-tax non-qualified investment account, maybe we roll it into a Roth IRA. Yeah. So there's so many, even in these years which sound like are simple, there's no RMD, it's simple, right? No, actually this makes it a little more difficult. It gives us a little more choices, and we have to work closely with the advisors and the clients to make sure that they can get the best possible outcome. So, I think that, rolling in from that is we'll talk a little bit about what we think the changes will be in the Biden tax plan. And that's why, and one of the things we're talking about right now is really based on, with all our clients and our planning, is what's going to happen and what's going on. In a traditional environment, when taxes are stable, we tell clients they want to decelerate income or push income to the next year and accelerate expenses. So we can take a deduction now and then pick up the income next year and pay taxes on 15 months from now. And that's what we normally do. When income rates are falling, we do the opposite. We want to accelerate income, and we want to, interest rates are falling. We want to do the same thing. We want to have more expenses now, and income in the future, so we can pay them on. In the flip situation, where when we think taxes are going to be higher, we're going to ask you to put income in this year and then save those expenses for next year. So we can say that, and if it's a 3 to 5% savings, if we're talking on $200,000, that could be $6,000 to $10,000. And so it's talking real money for a lot of clients that we're trying to do this with. So if we go back to 2017 or 16, at the end of 16, after President Trump was elected, we had that conversation with clients. We expect taxes are going to be lower in 2017. We expect that we're going to have to pay less. So we want you to hold off on putting that income in and put it in 2017. Well, we all know what happened in 2017. The tax rates didn't change because of one reason or another. It didn't happen. So then we got to 2018, and in December 2017, the tax changes were enacted. So then we did it again for clients because we knew this was going to happen. So accelerate income and decelerate expenses and stuff like that. We can have that or decelerate income, accelerate expenses. Sorry, confusing myself today. It's a decelerate income, accelerate expenses, and so we did it again in 2018, knowing that was the case. And it was also a big case in that case because a lot of people were going to stop being able to itemize deductions. So we had them accelerate their itemized deductions and maybe medical expenses or other things they may not be able to get in the future. So even in a case where we were wrong in a sense that we didn't get that tax law change in 17, it eventually happened and we ended up having to do it anyway. So it's good practice. So that's what we're kind of looking at right now. So do we expect, thinking about, do we expect these, before we get into that, do we expect these tax law changes to occur? It really comes down to a couple different things. Right now, probably the most important thing it comes down to is the 2 Senate races in Georgia. Right now the Senate is 50 Republicans, 48 Democrats, 2 independents. The 2 independents typically vote with the Democrats from the coalition standpoint. So we often treat those for the purposes of our tax planning or we're looking at tax changes as Democrats. So let's say it's 50 to 48. Well, let's say the Democrats let's say that the Republicans get both senators or it splits. And it's 51-49, 52-48, stays that way. Then we have a situation where Congress would need to have 60% of the vote on both the House and the Senate to pass a tax law. Not likely to occur. We're not going to find 10 Republican senators to flip in that thing. So I think, if we have a split vote in Georgia, or the Republicans take both of them, many of the things we've talked about, I'm going to talk about in the next hour, probably won't come to fruition in 2021. Might happen in 22, more likely probably in 23 when there's another Senate vote to flip the Senate that way. So so the problem, of course, we're faced with in tax planning is that we're not going to know that answer until after the election, and that election happens in January, and we're planning now for the end of the year. Yeah. Let's say that the Democrats get both senators in Georgia. Now we're at 50 and 50. And you say, well, that still sounds like not a majority, right? Well, there's a little process called budget reconciliation. And what happens is if you control the House, which they do, and you control the White House, which they do, and you control the Senate, which they do based on a 50-50 split, and they get the tiebreaker vote, which is the vice president. So they essentially are deemed to control the Senate. You can do it you can make tax law changes with just a majority. So in that case, many of these changes might happen next year if they get that. So as you see, we're in a kind of a pickle from a tax planning perspective because we don't really know what's going to happen in those two Georgia races. And so we're going to have to kind of make a play and plan based on what we think is going to be the likely case and the likely scenario.
So can I ask you another sort of broader question before you move on? And I know you don't know the answer to this, and nobody does. It's like when people ask me what the stock market's going to do tomorrow. I have no idea.
Mm-hmm.
But I think forgetting about the short-term politics for a second, because that's sort of what we're talking about right now. From a long-term perspective, I mean, if we look at the last 20 years, I mean, we've been in relatively low historical tax rates. Do you think with the deficits and the debt that we've accumulated as a country in general, that tax rates can stay low? Or, I mean, like, what's your speculation on the longer term tax landscape, not just the next year or 2 or 5 years?
Yeah, I mean, I think that that you're absolutely right. There's definitely a worry about where we're going to collect revenue. Now, most of the tax revenue is collected in the upper brackets. The lower brackets count for a very small
That's
percentage.
still true, correct? Yes.
Right. That's still true. So if I make a change, and you know, in the Biden tax plan, we'll talk about this in a minute, it has a change. It's all sort of in the upper brackets. If I make a change, a 3 to 5% change in the upper brackets, the amount of revenue I can collect is huge.
Okay.
And that I, you know, if I make a change in the lower brackets, the amount of revenue I can collect is going to be pretty small. You know, same thing with the FICA, the changes that President-elect Biden suggested, that should collect a lot of revenue for the Social Security and get a lot of money into there and help with that. So the answer to the question is no, I don't think we can continue down this path to be fiscally responsible without raising tax rates. But the plan that Biden has proposed, which we'll get to in a few minutes, and the plan really tax the higher brackets and the higher net income individuals will probably raise a good amount of taxes and solve that purpose and meet that need and that goal that they're trying to do. So
okay, that's a good perspective. I mean, I do think there's a misnomer out there still that, you know, even the average person is paying a lot more in taxes, but I don't think that's true. I mean, I think in general, if you look at from the data I see, the tax rates are relatively low for people making under 400,000.
yes, there's no doubt about it. When we did a tax analysis for pretty much every client. We went from the 2017 taxes to the 2018 taxes under the Trump Tax Act. And almost every single client paid less in taxes. Now, there is no doubt that when you were in the upper brackets, it was significantly less. You know, if I had clients that making $600,000-$700,000, they were saving 7 to 10% on average. Yeah. You know, someone who's in the lower bracket might have been saving 2 or 3%. Everyone less, but it was definitely weighted to the higher brackets. Okay. No about that, and they were getting the greater benefit.
Well, it's just nice to hear that information because sometimes you hear different things depending on who's putting the spin on it. So.
Right. You know, it's interesting. The one group that seemed to pay more in taxes were the single people who made between sort of $300,000 and $500,000. And I kind of called that the California and the New York. You know, I'm going to poke my finger at you tax because those were all generally individuals who have options and grants and RSUs. And so that, you know, those are people often more in New York and California than probably other places in the country, maybe other than Austin or Colorado, Denver, or some other small places, but definitely the lion's share of them. And those people, interestingly, often paid more in tax under the new tax plan because of the way the tax rates were shifted. And I always joked, I mean, I can't imagine they were that smart to do that, but maybe they were at the end of the day. So, unless you have any questions, Melissa or Josh, I was going to move, or there's anyone in the chat, I was going to move into the actual specifics of the tax plan. Sure. So the first piece of the Biden tax plan is that if you make less than $400,000, there are no tax changes, none. You know, so, you know, if you are making less than $400,000 and you don't care about anything else I'm going to talk about, you can probably just, you know, go to sleep at this point and you'll have another nap for 45 minutes because there really is no difference. And it makes sense. The people under $400,000 are kind of the political base of the Democratic Party. And if you were to raise taxes on them, you would almost be creating what you would call political suicide. It would cause a real ripple effect. People would be unhappy. They would pay more in taxes. And so, the government, and we know politicians, they do not like to raise taxes. We've seen it time and time again. President Obama, when he came in after the Bush tax acts, ran on a platform that these taxes are bad for America. It's almost exact quote, probably. These taxes, the Bush Tax Act is not a good tax act for America. In the end of the day, in 2012, he made one tax change to the Bush Tax Act. And all he did was raise the 35% bracket back to 39.6, which it was prior to the Bush Tax Act. So again, could have raised, because it lowered taxes across the board. The Bush Tax Act, again, was very similar in the sense of the Trump Tax Act. It lowered taxes across the board, saved money for a lot of different people. It certainly was much more beneficial at the upper brackets. And President Obama, when he made his change, made one change. I think that's what history is telling us, is that presidents don't like to raise taxes. Congress and the Senate does not like that to raise taxes. But if they can do it on their political base, it won't happen. Josh.
I think timing's a difficult one too. And I think what's interesting about this period is it's somewhat reminiscent back in 2008 when Obama did come into office. He ran on the platform of raising taxes significantly more than he did, but we were coming off of a very, very strong recession. In fact, at that point, the Democrats held the Senate, but it was very hard for him to get anything through because of how devastated everybody was feeling because of the recession. And I wonder if some of that's going to be similar now. Even if the Democrats take the majority in the Senate, are they willing to raise taxes in an environment that we've just come through with a difficult stock market, a lot of people hurting? Now, given the fact that maybe it's only over wages over 400,000, that could certainly play into it because those people may have been impacted less. But timing's tough, and it'll be interesting to see how that plays out. And if we look back in time, it certainly made it harder. Like you said, he didn't get it passed for several years, and even when he did, it was certainly watered down by that.
Yeah, absolutely. And that definitely is one of the, when we talk to clients and ask them, when they say to us, well, why wouldn't it happen in 2021? The number one reason is the Senate race, because that just creates a roadblock that we can't do it. But you're absolutely right. That is without a doubt the second reason we talk about the history on Obama's tax rate changes is a perfect example. Comes in 2009, has a Republican Senate, has a Republican Congress, can kind of do what he wants to do and make this all work. And you're absolutely right. The downturn, it was just no way. Again, political suicide to raise taxes on your base, political suicide maybe to raise taxes during a recession. You just don't do it. So, and this has been such a weird recession where we are now. Clearly in 2008, it was a clear recession. We have clients now that make more money than they ever have. This is just such a weird recession than we've ever seen. In 2008, everyone did worse. Some people did really bad, and some people did a little worse. This is not a normal recession without a doubt, because some people are doing really, really well, and some people are doing really, really bad. So that's the part that lends me to not able to make that strong statement like we did when in 2008 with Obama. But it's certainly a reason and a thought process that could come through.
And maybe that split at 400,000 plays more in favor of tax changes getting through, because it wouldn't necessarily impact lower wage earners, but we'll see.
Right, and I think one of the conversations, one of the things is that the Social Security taxes, if you make right now, if you make this year's is 137.2, next year is 142.8. If you make more than that, the 12.4% FICA taxes are no longer collected on your wages from your employer or from you. So, if you make $500,000, you're talking a 6.2% savings on, $370,000, $360,000. It's a lot of money saved. So under this tax act change, one of the Biden's key items is to raise the FICA taxes. If anyone makes more than 400, there'll be a sort of a period from where it stops. Let's say this year 142.8 until $400,000, you won't pay that 12.4. But then when you go to $400,000, the 12.4 will start again. And so that's only going to, so if you make $1 million, you're talking about 6.2% for you and your employer, 12.4% on $600,000. A lot of money to be raised, $70,000, $80,000. Sure. We all know the status of the Social Security tax, trust fund. this could be a place where, you know, a president like Biden says, you know, damn the recession, damn what's going on in the economy. We need money in Social Security. We need it now, and this is the place to do it. And so I could see that maybe the tax rate changes don't go into play, but this goes into play because this is helping solidify Social Security trust fund, and that makes the you know, the current retirees happen. That makes the people who are retiring in the next 5 to 7 years happy, and that is a really big political, without a political fireball kind of has to.
It's an interesting one because, as you said, not only does it raise taxes on the employees who are earning that, but the employer takes that burden too. And we all know what happens when employers' taxes go up is who ultimately pays for that. Their employees, to some degree. Less benefits, less raises. It's coming out of somewhere and likely not their bottom line.
Right.
And I wonder if that gets considered too, because
Sure.
the truth is, it's probably going to trickle down to the average employee earning less than $400,000 if their employer has now a 6+% increase in their taxes that they owe on their side of the FICA tax.
Yep. Yeah. You know, and I would say that if I was a betting person, if you took me to Vegas right now and put a bet on it, this piece I would bet is not going to happen in 2021, but I could see it very likely to, if they have a Democratic Congress or have the ability to pass it, certainly in 2022, this piece coming into play. This is something I can see playing in 2022, but I agree. I think with the economy issues and everything else like that, it would certainly not be the place we want to go. Actually, you know, if you remember, in 2008, 2009, there was actually a reversal of the tax rate. It went down to 4.2% for individuals and companies for that short little period for about 2 years under the Obama Tax Act. It did the exact opposite. So they throw more money into the economy and less money into the Social Security tax fund. So that's an interesting one. You know, staying on the individuals right now, you know, the other big piece of one of the other big pieces in the Biden Tax Act is that the current rate for people over $400,000 is about 35%. It could go up to as high as 39%, 39.6. There's a 37% bracket, which starts about 520. That would certainly go up to 39.6. So we're looking at a 2.6% to 4.6% raise for any income over $400,000. You know, so that's sizable. You know, and just $100,000, we're talking, you know, anywhere between $3,000 to $5,000 in taxes. So, you know, a client that makes $1 million, we're talking, you know, we could be talking $60,000 in taxes. So this is definitely a place we're doing that tax planning. We have clients, high net worth clients, high income clients. We're saying, okay, you might want to think about accelerating that income in, even if it only happens this year and next year it doesn't happen, but it happens in 2022 and we do the same thing again, then all we lost is the time value of money. And right now the time value of money is pretty small because interest rates are pretty low. Obviously the market is doing very well, which makes the time value a little more expensive. But you know, if they're keeping that money in savings accounts or other things, it's earning nothing. So that's all we've really lost if we're shifting income from one year to the next. So that's a big one, and you know, again, history says this is the one place that Obama made the one change Obama made in his tax act. So if I was a betting man and you wanted me to go out there, if the Democrats have control of the Senate, I can, you know, I would almost guarantee this is going to happen unless they feel like the economy is in too shaky a ground to do that. And then again, that would probably be a 2022 item. Capital gains. This is a hot button issue. And I've heard lots of different thoughts. I've heard a lot of misinformation about this. I actually had a friend call me who's a client who was afraid to have her mom come over for Thanksgiving dinner because they were having an argument about capital gain taxability, and she didn't want to get in with it. So she's like, "Can you just give me the right answer?" So when I talked to her, I have it. It was pretty funny. I know the mom and the daughter very well, so it was I could see them having an argument about this. But the mom was saying that she was going to get taxed on unrealized capital gains. And unrealized gains, the gains that you have not sold. That, you know, I bought Apple stock at 100, it's now worth 1,000. I haven't sold it. I have $900 of capital gain. You know, I don't typically pay tax on that until I make that sale. Well, there have been tax proposals passed out there before that would say that we're going to tax unrealized gains. That every year you would have to submit the value of your accounts and you would pay tax on it. I'm happy to say this is definitely not in the Biden Tax Act. I think the logistical nightmares of trying to deal with this would just be unbelievable.
Yeah, I can't even imagine imagine that for every client.
And then you'd have to do it for
You guys and to us would just be crazy. So I'm glad to say that this is not something on the Tax Act. So they were able to have I gave them the answer and they were able to have their Thanksgiving dinner. So that was the nice thing that, in peace. But there is a number of things in the Biden tax plan that are pretty substantial and worrisome in some ways. So the biggest piece is that the way that it stands, the way the act is written, or the way he wants to do it, is that if you are over $1 million of income and you create a capital gain, and this would be a long-term capital gain because short-term capital gains are already taxed at ordinary income tax rate. So anything you've held for more than a year would be taxed at ordinary income tax rate.
It's huge.
Instead of being taxed at 20% for the capital gain rate, 3% for Pennsylvania, if you're a Pennsylvania resident, and the 4% for the Medicare taxes, so at 27%, you were probably looking at closer to 47%, the 39.6% rate, which we would expect to be in place at that point. The 4% Medicare tax, so we're at 44%, and 3% Pennsylvania. So we would go from 27% to 47%. That's a big difference. That's
And
a
that's
big change.
on all of the capital gain, if you make over $1 million, it's not like a threshold, like.
No,
yeah.
Correct. If you get over $1 million, if your ordinary income gets you over $1 million, and of course, what we don't know is if I sell my income's $700,000 and I sell a $500,000 capital gain, and so that puts me over. Is the lower half going to be at the regular income tax rates and the $200,000 be all of it, or because I'm at all of it? Well, there's lots of different pieces here that are obviously worrisome, worrisome in lots of different ways. We have clients in California that are going to sell real estate, primary resident real estate, and they're going to have capital gains on that real estate because there's a $500,000 exclusion above and beyond your basis. But California, New York, Boston, we have clients in all the Florida that are in these high net worth, high real estate areas, and they're going to have more than that kind of gain. They could have $1 million capital gain and just their primary residence. And so does that now become subject to ordinary income taxes under the Biden tax plan? Yes. So, there's definitely things that we're going to have to think about. If this law passes, you as our financial advisors and us as the tax accountants and the planners are really going to have to really think about what are we doing in regards to sales. Right now you just sell.
Selling a business, huge.
Yeah,
impact.
all that stuff. Selling a business, selling real estate, it will all have a huge impact. And it's really, really worrisome. What are some of the things we're talking to clients about on that? Is obviously one, thinking about looking at capital gains now and trying to maybe in this year and next year, because again, do we think it's going to happen in again, if the Senate doesn't go Democrat, this is something that's never going to get passed by Republicans. We don't have to worry about that. But if we know that's going to happen, maybe in 2021 and 2022, we're looking at harvesting capital gains, get rid of some stuff. Roth rolls, do we make IRA rolls to Roth rolls because those are not going to be subject to anything, and we're taking money out of when we do a Roth roll. If I roll $1 million of IRA money and I have $300,000 of ordinary income tax, and I use some of that my non-qualified money to make that payment, I've now reduced my potential on this taxable item, and I've put $1 million into a Roth. So there's lots of different plays we can do with this. But once this act comes, if this tax law changes and becomes a law, we're going to be, our tax plan is going to take a whole different level. Right now, when we tax plan, we estimate capital gains unless there's some big sale of our real estate or a business, unless the financial advisor says to us, yeah, we definitely have sold a lot. We estimate these a little bit because it's not going to make a big change, whether it's $50,000 or $60,000. We're talking $1,500 in taxes, $2,000 in taxes.
Right.
Not going to make a huge change. But now if it's $4,000 versus nothing, this could be coming into play. This could be a big piece and something we'll definitely going to have to spend a lot more time in our planning and worrying and thinking about. And as financial advisor, you guys it'll become a bigger piece because obviously you do not want your clients coming back to you and saying, well, I didn't realize I was going to pay 50% taxes on that sale. So questions about that?
No.
Are they still considering the step up in basis at death?
Yes.
being removed?
As of right now, the step up in basis is still there upon death. Two things that might happen there. One is that they may lower the tax that right now the inheritance tax, the trust tax return if your estate's greater than less than $11 million, you don't pay any taxes on this, any state taxes in the federal government. We pay in
State now, a state tax, not income tax, not capital gains. I'm just clarifying for clients.
Yep.
It's-
Yeah, the state taxes.
Yeah.
Now, that number has been as low as $1 million 20 years ago.
Yeah.
So will it go back to $1 million? Maybe. Will it go somewhere less than 11? Maybe. One of the conversations Josh has just mentioned is to not give you the step up. Keep it 11, but don't give you the step up. So
Let's define what the step up is for clients who don't know.
Sure. That's great. Yeah, sorry. So the step up is when someone passes away, the basis that they have in an investment goes to the fair market value of their date of death. So if I have had Verizon stock since 1960 and it's worth $200,000, but I paid $2,000 for it. If the person sells it before they pass away, they have $198,000 capital gain. If they wait until they pass and pass it on to their heirs, their basis becomes $200,000. And so if they sold it the day after the person passed, the capital gain would be zero.
Yeah.
Or essentially zero. So that's
They're talking about eliminating that.
right. And they're talking about eliminating that. It has been eliminated in the past. Just again, history. 2010, the estate limit actually went away. There was no estate limit under the Tax Act. But the flip side of that was there was no step up in basis.
Right. Which actually impacts more people even in lower net worth.
Oh, absolutely.
And where I find that this happens a lot with clients is, oh, mom and dad gave me their house 15 years ago. They put it in my name.
Yep.
Well, what they don't realize is the implication of that is they lose that fair market value step up in basis on the sale of mom and dad's house when they pass.
Correct.
Because they inherited the basis of the parents because it was a gift. I see this happen probably at least 4 or 5 times a year. So I'm only bringing that up because I feel like that's a huge planning issue that people do with their parents. They think they're protecting that house or that money from long-term care or other things, but they're losing that fair market value step up and they have to pay capital gains when they otherwise would have had to pay very little or nothing.
Right. And I think that's a great point, because there are elder care attorneys that we both know that could really do something that's better to protect it from those side of things and not lose the tax benefits of a house or even a stock. If your parents have that same Verizon stock and they gift it to you to save money, well, your basis now became $2,000, not the $200,000 you wait till they pass. So I see it time and time again. I agree 100% with you, Melissa. It's a bad tax planning maneuver, but could be other reasons as long as everyone knows the reasons to do it. And you've reached out to an attorney and feel like this is the best way to go. I don't have a problem with it, but I think you're absolutely right. Most people don't understand that.
Well, 90% of people just don't even realize that implication.
Yeah.
I think that's the important thing is whatever the planning is, go into it with your eyes open, understand that when you do things like that, there are legal ramifications and tax ramifications. And sometimes, the tax ramifications may make the legal ramification, not as important.
Yep, absolutely. Absolutely. We all have to weigh both things, but we have to go into knowing about both things when we make our choices.
Right.
I was going to move a little bit into sort of business changes here. Actually, I'm going to back up. We're going to talk about a little bit of real estate changes, and then we'll go to business changes. There are 2 big items in the Biden tax plan that is kind of buried in there. No one really knows too much about it, hasn't really thought about it, that are 2 really big items. So the first one is if you make more than $400,000, there is a piece in the tax plan to reveal what's called a 1031 exchange. And a 1031 exchange is when I buy a piece of real estate or sell a piece of real estate and I use those proceeds to buy another piece of real estate. So if I do that, the gains on that real estate can be deferred indefinitely until I sell that piece of real estate. This is a great tax planning maneuver, is used. It's difficult. It doesn't always make sense. Capital gain rates are pretty low right now. Sometimes it makes sense to just pay the taxes and not do it. But if I had a client who was in his 80s and was selling a piece of property, I would certainly think about this sort of maneuver to do that, because when that client passes away, these heirs will automatically get the step-up basis and will never pay capital gains on that amount. If I'm thinking of selling something in the next 5 years, it may not make sense. Every client's individual. But if this tax act goes through the way they want, that won't even be an option for someone making $400,000. So if I have a well-to-do older client who's got $400,000, sells a piece of real estate, and we may not even have the option to do that 1031 exchange.
That's a big change.
That is a big change. It's a very big change because again, I would, whereas when I have a client selling a piece of real estate who's in the, anywhere between the 32 and below tax bracket, I don't always necessarily feel that the 1031 exchange works because we're only paying 15% capital gain rate. We're only, and we don't get it for PA. We 15% capital gain rate and possibly 4% on some of it. So it's not really a great savings, but certainly a client who's getting in the top tax bracket, 39.6. Add on top of that the capital gain rate change of the $1 million, where they might be paying ordinary income taxes on that. Wow.
If they're selling the real estate, it might throw them into that $1 million, which then triggers that capital gain increase as
Absolutely.
well.
And you take the 1031, takes it all out.
We have a lot of clients who have really large portfolios of rental property. So I mean, that could be in second and third homes,
Yep.
in Florida and Delaware and other places. I mean, those are all going to be impacted by that if they sell them.
Right. Agreed. The other one, which is called, they're going to eliminate what's called the 754 step-up basis if you make more than $400,000. And what that is, it's kind of complicated and confusing. But if I go into a rental partnership and I buy out Melissa's shares, and I buy Melissa's shares for $500,000 more than she paid for them, I essentially get to depreciate that extra $500,000, that extra amount.
Goodwill.
It's good. It's treated like goodwill. Yes. If I buy your shares, I don't get to that, but because rental's different, I get to essentially depreciate that, reducing my tax liability for all the period of time. I don't have to wait till I sell it to get that extra benefit that I paid for your shares. So it's a really big tax benefit. And again, high net worth clients who go in and buy, often don't buy necessarily the asset per se, but buy the shareholders, especially in professional practices, practices like our practices, physician practices, attorney practices who own the real estate. You're usually buying the asset, buying the shares of the prior owners. You're not buying the asset. So this will really hurt those people. And again, is it lots of money probably in a day? No, but if it's $20,000 a year at the top tax bracket, $8,000 to $10,000 in taxes right there that you won't get. So it can end up being a lot of money, especially for someone who does do a lot of real estate investing and does how they do their investing. So it's worrisome. From a business standpoint, the one big corporate tax rate changes. There's a bunch of changes, but the big one I think for most individuals, the one most people are thinking about, is that if you have a C corporation, which is a regular corporation where the income of the corporation is not passed through to the shareholders, which is typically called an S corporation, its corporate tax rate now is 21%. That was a huge drop under the Trump Tax Act. It was generally 35% and it went down to 21. Under the Biden tax plan, the 21 would become 28.
That's about where it was, right?
It's still lower. It's still lower because it was about 35 was the average rate for most people. But now it's at 28 would be higher. There will be a minimum tax imposed upon C corporations. So that, again, a lot of corporations, between offshoring, expenses, this or that, are able to kind of get rid of some of their income taxes. So there'll be a minimum tax, just kind of like there is. We have on our individual tax, there is already an alternative tax for corporations, but it will kind of be tightened up so that, the theory is that every corporation, big or small, will pay some form of tax at the end of the day. But, for most small corporations, this is really not an issue for two different reasons. One, most small corporations are S corporations, which means the income is actually passed to the owners and it's paid on the owner's tax return. And so S corporations don't pay corporate income tax. Back when 2018 Tax Act happened, we did an analysis. Did it make more sense for my S corporations to be C corporations? And due to the fact that Pennsylvania has a 10% corporate tax rate, it still didn't make sense to make them C corporations. Individual tax rates were still cheaper. So this just makes that case even more. So we had clients come to us and say, should I be a C corporation? We said no. Now, if they came to me and said, should we be a C corporation? I would say, absolutely not. This just got 7% worse than it was a year ago.
With regards to the stock market, I think this is kind of an interesting one also because I almost feel like the market was pricing in if a Democrat were to take the White House the possibility of the corporate tax rate going back up to 35%. So the fact that it's being proposed to only go to 28 is almost like a backdoor win, I think, to the stock market, because to some degree they probably priced it was never going to stay at 21 under a Democratic Congress and White House, and the fact that it's not moving all the way back up, that actually could be a good thing.
I mean, the takeaway from this, from a corporate standpoint, if you are a C corporation, you should really talk to your advisor about whether or not you should make the election to an S corporation. There's positives and negatives. There's things you have to do about it, but it is possible.
Yeah. On that note, you just reminded me of something. So, and this is a little unrelated, but related. It's not related to any changes, but I see a lot of people shifting from being employees to either going 1099, becoming self-employed, starting their own businesses, and they're setting up LLCs, which is probably appropriate, but then they're getting to $100,000, $200,000, $250,000 in income, and they're still in an LLC with no S corp election.
Mm-hmm.
Can you just talk about that for 30 seconds, a minute? I mean, I'm not really sure why other accountants aren't doing that, but I know there's a huge benefit to doing it.
Yeah.
So,
I laugh because you want me to talk about something in 30 seconds. It usually takes me an hour to explain to a client.
well,
I'll find a way. I'll find a way.
That was
But-
why I said
Set up another webinar.
the 30-second thing was a hint, like, let's keep it short. No, I'm teasing. Go ahead.
Well, you know me well enough that I don't keep much things for you. But yes.
Just to let people know that there's opportunities out there.
Right.
I'm surprised at how many business owners are not taking advantage of S corp election when I meet them.
Right. So that's a great, so the short answer, I'll try, maybe I can keep it to 2 minutes. I don't know about 30 seconds, but the short answer is that, yes, everyone should set up an LLC if they're going out and doing business on their own. The LLC gives you liability protection, gives you the ability to protect your personal assets should you get sued or anything like that. So there's no doubt that's the right call. The beauty of the LLC is that it's a morph for tax purposes. It can be either a sole proprietor or an S corporation or a partnership if there's two of you. And so we really look at that and say, okay, when do we make that S election? And really to us, it's a cost benefit analysis. When the savings from our taxes are greater than the cost that we will incur by being an S corporation, and basically the three costs that you incur when you become an S corporation is the cost of doing a payroll, because you have to now run payroll for yourself, the cost of doing planning, because you have to figure out what your payroll is going to be, and the cost of actually doing the corporate tax return. Now, if you already have employees, then the cost of payroll goes away. So the cost benefit is now lower. The costs are lower. If you're already doing planning because you think that's an important thing, then you don't have to do that. That's going to be not different. So that goes away. But basically, those are the three changes. So it's a cost benefit request. And generally, when the income, the net income, not your gross, but your net income is greater at a certain level, it makes sense to make the change. At this point in time, when our current tax laws and where we're at, the net income level is about $35,000 to $40,000 is generally what we say. We can be more aggressive and we can make it lower. We can be less aggressive, make it higher. But for what we like to do, it's about $35,000 to $40,000. So if you are
making more than that,
be more than that. So if you are a sole proprietor, LLC sole proprietor, whether you're an LLC or not, we can still change that. But if you are a sole proprietor that consistently makes above $40,000, you should be an S corporation.
Yeah.
You'll save money. Now,
so
why don't people do it? Generally, there's three different reasons. One is laziness, because it's more work. It's things you have to do. It's not as simple. So there's a thing to do. Second is cost. They're afraid of the cost, but we've just taken care of the cost. The third one is that from an accounting standpoint, a lot of accountants don't want to deal with it. They want to see their clients once a year. They want to prepare the tax return. They want to be on the golf course come May through November and not see them again until the next winter.
It's certainly more complicated.
So we see a lot of accountants, that's the reason. How many clients come in and say to us, my accountant never talked to me about this. And generally because they just don't care.
Well, I am finding that, and I'm not beating any accountants up or anything, but I mean, we find wealth advisors.
Yeah, it's very common.
I mean, we review whether our clients make $50,000 or $1 million. We review their tax returns, every single one, and we proactively look for opportunities to direct to their accountants, because obviously we don't do the preparing. But I repeatedly find this issue, and the clients always say to me, "I didn't even know about this," and it surprises me.
Yep.
So I'm glad I just bring it up today because I know there's a lot of different kinds
Right.
of people on the
And I can
call.
tell
Some
you that
individuals, but we also are finding a lot more people, we're doing a lot more business consulting and setting up businesses. Clients are coming to us saying, hey, I've been unemployed for a year. I didn't like my job anyway. COVID's making me rethink things. I want to set up this business. I have no idea what I'm doing. Can you help? Absolutely. And then we, can help connect them to somebody like you or an attorney, because there's kind of there's a three-pronged stool. There's your accounting, your legal, and your, financial advice. But I keep coming across this issue. So thanks for clarifying that in less than 5
just
minutes.
for someone who makes about $100,000, the tax savings after expenses are almost $4,000. So this is not small money.
And that's an IRA contribution.
It's an IRA contribution. It's a Roth IRA
legal
contribution.
entity. You can just remain an LLC.
Right, it's just
how
an
you
election.
file your taxes.
Yeah, it's not really that hard. I mean, we know that. And I think people are scared of what they don't know. So I think that's just a good clarification.
Right. We're happy to talk to, I've been doing this for years. That's one of the things that I do a lot of is moving LLCs, sole proprietors who are not LLCs to LLC S corporations. We do a lot of it. We're happy to talk to anyone, anytime about that.
Yeah.
It's a win-win in my book, to be fair, to be honest. We collect more revenue for ourselves because we are doing more work, and you're saving a lot more revenue and saving a lot of money on taxes, and it's a win-win. So, selfishly, I get more work and I'm happy about that, but I'm not going to do it if it doesn't make sense for the client.
Yeah, exactly.
Agreed.
So that's a good segue into one of the last, there's two more changes we're going to talk about. This is a big one. This is one that worries me intensely. So there's something called the qualified business income deduction. Often you might have heard it. It's called QBID is a summary. The 199A deduction is also what it's talked about from time to time. And a business owner can possibly exclude 20% of their business income. So if I make $400,000 for my business, $80,000 potentially could be tax-free. I don't pay any tax on that $80,000. Under the Biden tax plan, if you make more than $400,000, the 199 deduction will maybe removed, phased out, go away. We're not certain how it's going to work, but basically, I have owners who make $1 million in their business. We pay them $200,000 of a wage, they get $800,000. They're a manufacturing or otherwise, basically $160,000 of income is tax free. We're talking $40,000 to $50,000 of taxes that they're saving on this. That if this passes, the next year they'll pay for it. This is a huge piece. This is a huge moneymaker. This is, Josh, wrapping back to your original question, think how much money they will make from people if they got rid of that. And these are the places that they will attack.
That was a pretty new change to enact that, though, right? That was part of the Trump changes back in 20.
Yes.
Right?
Yeah. So
again,
under $400,000.
Not historically significant, but today it is. We kind of think about things more from like a global stock market perspective, of course. Obviously, it impacts us and it impacts our clients, but the questions we get are more, how does this impact the market? If it's always been that way before, I don't know how much that'll materially change the stock market, but certainly from a bottom line perspective as it is today, yeah, that's a big change. For sure.
Yeah, a lot of business owners, when I told you about, we looked back at the 17 versus 18 tax changes, a lot of the business owners, their tax savings came from this 199A deduction.
Absolutely.
I think that would be huge.
Yeah.
So the last thing we're going to talk about is just some family tax laws. There's a bunch of things in the Biden Tax Act that will affect. So everything we kind of talked about here, if you made less than $400,000, it didn't matter.
Yeah.
Didn't have to affect you.
Or if you weren't a business owner or didn't have rental real estate, right? And that's a lot of people.
Right, and that's a lot of people. This thing that we're talking about right now will affect people making under $400,000. These are sort of the changes that Biden would like to put in play that will help those people do that. And all of them are going to be reduction of taxes, credits, help reduce those tax amounts. One, right now, if you make under a certain amount and you have a kid under 16, you get $2,000 for that kid. If you have a dependent on your tax return who's over 16 and is still possibly a student, up to 25, you can save $500. If you have a potential dependent, there could be another $500. So there's money to be saved, which is called the child tax credit. Now it's called the dependent tax credit on these things. Biden wants to expand that number, make it maybe $3,000. We don't have a solid number on what that is, but he wants to expand that number so that people, working families, get even more money for their kids. If you remember, one of the big things in the 2018 Tax Act was that there is no dependency deduction anymore.
Right.
6 kids, it doesn't change anything. This is where my
The exemption got eliminated.
so this is where my 6 kids come into play.
All right.
They're looking at a tax credit for health insurance that you pay.
That could help retirees a lot.
That could help retirees a lot. Could help a lot of self-employed individuals. Right now, a lot of people who work in, a day-to-day job, get a W-2. Their health insurance they pay is pre-tax because we have what's called, Section 125 plans that take our income pre-tax. So the question is, if I'm still paying for it but doing a pre-tax, will I still get this credit? So there's lots of things that will have to be worked out on that. So we don't know what that's going to be, but that's something out there. Right now, you get a tax credit for every expense you make for a childcare up to $6,000. You get about 20% credit. They're talking about expanding the amount of the credit and expanding the amount that you can the higher level up to $8,000. So if it stays 20%, you could get you can now get $1,600 for the kid versus
These
$1,200.
are credits opposed to what we've been talking about a lot of, which were deductions.
Correct.
Credits.
These are credits.
Significantly better.
Credits are more impactful.
They're
than
more
deductions.
impactful than
Correct.
deductions. Just to point that out.
Correct. Thank you. Yes, credits are a dollar for dollar reduction in your taxes. Deductions reduce your taxes based on your tax rate. There's a tax credit there in caring for aging relatives. What does that mean? We don't know. There's not a lot of details on it, but it's it's there. So if we have a relative that's living with us, do we get a credit then? Are we going to get a credit if we have to pay for medical expenses for them? So it's going to be interesting to see what that kind of comes out to. But that's certainly something as the baby boomers get older and as the baby boomers become more infirmed and we as children have to take care of them, this could be something you can have for us.
Okay.
There's a tax credit for buying a first home. If those of you remember, there was actually a tax credit in the Obama Tax Act for this, where you got a credit for buying a first home. You paid for you got it. You got the credit immediately. You had to pay it off over time. It was forgiven over time. You sold the home before a certain period of time. You had to pick the credit back up. So again, not really certain where that is, but again, I think that this is something that we might see even before a tax act could come through a stimulus package. There's bipartisan support for things like these things. And you might see that come through even if there's not a tax act change.
Yeah.
And then right now you do get a tax break for retirement savings for like 401k contributions you make for things like that, but they may expand it so more people can get it. Right now the credit you get for putting money into a retirement is you have to have a pretty low income to take advantage of that. They might expand that.
Okay.
I saw something in the chat, Melissa. Is there something?
Yeah, I did. We got a question. It must have come up a couple of minutes ago. Is the $400,000 cutoff point for individuals or households? I.e., does this change whether we should file as joint versus married filing single?
That's a great question. There is no clarification on that at this point. We will assume that it's going to be $400,000 for a household and $200,000 for an individual at this point.
And just to kind of clarify on the last part there, generally married filing separate is made very difficult by the IRS. So usually you can't get around those households.
Well, there's also some other caveats to doing that, right? Like it limits,
Right.
It freezes you out for other things. So that's something to be really careful about.
And when we do it for taxes for clients, we can automatically run a married filing, joint, married filing separate
Right.
analysis. And in very, very few instances, does it make sense from a financial standpoint? Sometimes it makes sense because there are, loan forgiveness issues going on between the spouses. There's tax credits or tax debt owed that they don't want to refund.
It's hard to make that scenario work. Usually.
Correct. It usually married filing jointly is the best way to go, almost always. But if it's something you should have your tax advisor certainly look at if you think that it's a possibility. Most computer programs, it's literally a click and a look. So it's not like it's a lot of work for people to do so.
Okay. I have a couple of questions I want to get in if we can, do you have?
A couple minutes.
No, that's pretty much I was going to say that's pretty much the extent of what I was going to talk about right there. So let me know. Let's go for it.
Well, for everyone listening, if you do have a question, now will be the time to do the chat because what we'll do is go through those while I'm talking and make sure we get to your questions first. So Derek, that's all really good information. I think there's a couple other things. I think maybe some of our clients are thinking about, they're kind of older news, but maybe not a bad idea to reiterate them. So for example, you brought up the RMD thing at the beginning of of our talk here. So a lot of our clients who were taking RMDs, we have found that to be a significant planning opportunity to do other things, like for example, maybe convert some Roth money. Because if they're not taking their $60,000 or $70,000 RMD because they don't need it or they don't want to, that means that there's $60,000 or $70,000 that we may have to be able to realize to get some money in a better position for either estate reasons, or even just for more tax planning down the road. So
Right.
I do think that continues to be an opportunity, but that has to be done before the end of the year. Do you think that they'll do the RMD waiver again next year?
I do not. I would think that that was a one-time thing. I mean, unless the economy goes kind of poopy and poppy again, I think that they wanted, when they enacted it, really, if you think about it, the market went down, just a huge drop.
Right. They thought it was going to stay like that.
Right. Had they foreseen the market was just going to come back up to where it was before, I don't know if they would have done it, But there was so much pressure that people were saying, well, I don't want to take my money out when it's worth 30% less.
Yeah.
With the economy going what it is, we don't want people pulling money out of the market. I think that was a reaction to the market, not a reaction to COVID necessarily.
Yeah.
Of course, was
Well, in 2008 and 2009, it took a long time for the market to recover. I mean, it took much longer. I mean, years and years for it to get back to where it was. We recovered in a few months. I mean, literally. So I agree with you. I don't think they'll do it again. But for year-end planning, we are trying to make sure we get any Roth conversions or any kind of tax planning in. If there is, it was kind of back to your original discussion where you're saying, accelerate income now versus later. If you were eliminating some income anyway, but you wanted to realize some income on something else, I would think that now the time would be to do it. And so we are doing that with a lot of clients. And Roth conversions is a big strategy.
Great.
We've been doing, especially for clients who don't need the RMDs and they want to leave tax-free money to their kids. It really can be a valuable strategy. There's a whole lot of reasons. And as there's a lot of planning that needs to go into those discussions, and there has to be a purpose for it because there is a cost, which is paying the tax now. But those are strategies that we continue to see to be attractive. Another question I have for you, and I'm seeing this come into play again for the same reason, qualified charitable distributions.
Mm-hmm.
We have one client, I know we just worked through this a couple weeks ago, where they wanted to make a substantial contribution to a charity. They said, well, we can itemize if we do this. But then when we actually looked at it, it still made sense for them not to make it this year, but then do the qualified charitable distribution through the RMD next year instead of trying to itemize it, because they were just going to get a lot more bang for their buck.
Agreed.
So maybe comment on that a little bit.
Yeah. So the qualified charity deduction is if you're over 70 and a half, you can take money directly from your IRA and give it to your charity. And the benefit of that is that with these higher standard deduction rates, number one, it may mean that, what you may have been itemized before, you may not do so again. But the bigger piece is this, is that when that happens, it doesn't get included in my income.
Right.
So things like my Social Security might not be as taxable. The dreaded IRMA, which for the Medicare, where your Medicare costs more if you make a certain income, that could possibly go lower. So if I'm trying to keep under a certain level, that's a great way to do it. It is the best for someone over 70. It's by far the best way to give money to a charity.
Yeah.
There's no doubt about it.
Even if you add up the itemized deductions, literally you compare it to excluding the income completely, and the charity gets more because you don't have to pay income tax. It just makes a lot of sense.
It does. And the higher standard deduction limit just means that you're getting free money from the government and you're still getting the money of the charity.
Yeah.
That's the key.
Yeah. We have another question too. Does the $400,000 per year refer to AGI or is that taxable income?
Right now it's referring to taxable income.
Okay. And just to be clear,
yes, we believe it to be taxable income at this point.
AGI is before deductions typically.
Correct.
And that's what.
But most people.
Higher AGI.
Yeah.
Right.
Your AGI could be higher than your taxable income. Well,
Correct.
it will,
Usually
right?
will be, usually.
Because you're
But right now, because of the limitation on deductions and everything that's going on, AGI and taxable income is not very far apart for most clients. And
But
actually,
there's still some.
the biggest piece between AGI and taxable income for most clients at this point is actually that qualified business income deduction, that 199A deduction. And if you make more than $400,000, that could go away.
Yeah. Okay. Other questions? I don't see anything yet. It's 12, but I do have one. I have one more question. Do you see, or two more questions actually, if you don't mind. They're quick, I promise.
Now you got her going, so.
Well, no, I was thinking about these and I think these really pertain to clients. One is, do you see Roth IRAs going away or them possibly changing the rules around that? I get that question a lot. I'm actually asking this on behalf of clients. And then two, I know they've talked about this in the past, but given the poor economic state of a lot of state and local governments, do you think they would possibly eliminate the PA state and local tax deduction? I'm sorry, state tax deduction on the 529. Those are my two quickies, and then we can wrap.
All right. So Roth, here's my statement on Roth is that, yes, do I see it possibly going away at some point? Absolutely. It is a bad financial maneuver by the federal government, but they get the money today versus waiting for it tomorrow. So that's why they like it. If by chance somehow someone decides that they needed it to go away, what I would see it happening, how I would see it happening is that there would essentially be a cutoff, and we've seen this before, that basically Roths would still exist. You'd still be able to take money out tax-free. You'd still be able to treat them. You just wouldn't be able to put any new money in.
Okay, so they would probably grandfather in any previous money.
Correct. So I wouldn't see them making you take all the money out right away because that could create huge taxable issues for clients in the future. But I could see them stopping them, allowing you to do that. And that has happened in the past. There's pension plans out there. There's retirement plans that still exist to this day. You run across them from time to time. You guys, we do too. It's like, wow, I didn't even know this one existed anymore. Where people were able to get money in, and this plan still exists. They just can't put any more money into it.
Yeah.
So, but I really honestly don't think it's going to happen anytime soon. The government likes having the money now. They like getting the money now. It's a known part of our tax planning. For me be 50 this year, I'm not so worried about the financial effects. I certainly worry about my kids and grandkids, the financial effects of Roths. It'll be that much less money coming in for taxes, but maybe we'll just be that much better at other things. So maybe that happens. 529s. I could see that happening any given time, any given day, that stopping the 529 deduction. I could see them actually changing it more likely, but I can see them more likely changing it that you only get a deduction if you put into a PA 529.
Okay.
And that's what many states do now already.
Right.
Pennsylvania is one of the few.
Or maybe put like an income threshold on it. Like maybe you can still deduct it if you make under
Maybe.
X. We talked about that.
Right.
Yeah.
But I can see Pennsylvania.
It's not imminent though. I mean, a couple of years ago, it was actually on the table, I remember.
Right. I just see that the Pennsylvania 529 deduction makes no sense from a tax standpoint, from a fiduciary standpoint. I could put the money in today, get the deduction, and take it out tomorrow. So
yeah, I know, and we've done that for clients.
Yeah,
I mean, we do it for clients all the time. I mean, it's not a huge deduction, 3.07%, but it's something, right?
Yeah, right.
So
$300 and then 10 grand.
yeah, right. So
I don't. But at the same time, it's probably not. They're not losing hundreds of millions of dollars from it. So is it really a hot button issue at the end of the day?
no, yeah, I don't know. These are things clients ask. I bring it up just because I haven't heard anything lately, but maybe you have.
No.
You're always a good resource for that stuff. But okay. Well, I think in respecting everybody's time, we could probably wrap today. Thank you so much. This was
Thank you guys for having me.
And everyone else, thank you for listening to our really interesting, exciting, fun tax conversation.
Who knows? None of this could happen, or it
Right.
could all happen. We have no idea.
I mean, talk to your advisor or your tax and consult your tax accountant. But also, this is our last webinar for until the new year. So we want to wish everybody a really happy and safe and healthy holiday season. We know it will be different this year. We found, even with Thanksgiving, some of the other holidays, that even though it was different, it actually was interesting and fun to sort of reinvent what these holidays look like. So we stay positive through all of this, and we got a vaccine out there. So hopefully we are not going to say cheers to 2020 at all, but we'll say cheers to looking forward to 2021. And thank you for your continued support and also for being awesome clients. And thank you again, Derek, for joining
Thank
us
you, Derek.
today.
Thank you guys for having me. It's always good stuff to talk about.
Thanks.
Absolutely.
Bye, everyone. Happy holidays.
Happy holidays.